Okay. Yeah. Can I get an audio check? I just heard something weird on my end that I still have. Hello, hello, hello. Is there any? Okay. All right, good. Thank you. I heard a noise. It sounded like I got disconnected there. So anyway, this is sort of a holiday week here. A lot of people gone. Thursday's the 4th of July here, so these are fireworks from these are my fireworks from last year in my backyard. We blew these things off. This is a picture of it. And actually not, but we did have a visitation last year from the village finest here. The officers came by and told us to calm it down. So we did have some good fireworks going, but apparently we might have pushed the envelope a little bit. So this year we're going to try to mellow it out a little bit. We won't have quite as many. So all legal though, all legal. Sure. Okay. Let me get this thing going. What we're going to do today, what we're going to talk about today is leaps. Leaps. This is okay, Al, you have no audio. You may need to you may want to try hanging up because apparently the audio is working. So if you're not getting audio there, Al, let me type in, Al, let me type this in, Al, hang up. And redial. Okay. Okay, Jim. Okay, so there's another one. So anyway, we're going to go over leaps a little bit today. This kind of review. This is a thing that I did up maybe a year ago, I think, maybe something like that. But I've had some people talk to me about leaps over the last few weeks, so I thought maybe it might be kind of cool to go back through it again and review these. So I will, originally what I was going to do is just make this pure lecture and just go through an example or two on the PowerPoint, and everyone could just sort of kick back and watch that. Then what I thought I would do is instead I'll model out a couple of leap strategies on the software. So I'm going to toggle back to the software here like I do usually. So you'll see that. And then as always, folks, if you have questions, shoot them on in. The only time that I cannot see your questions, put them in on the chat box, is when I'm in the, when I'm actually in the software modeling the trade out. I can't see any questions. So at that time, I'm going to be just having to go through it. But when I'm on here, when I'm showing the PowerPoint, I can see all the chats come through. So I'll answer them as I get, as they come through. I'll try to jump at them. So feel free to ask. I want to make this as sort of informal as we can make it, just almost like a one-on-one session, except obviously the person on the other side isn't saying too much. So I get students like that once in a while that don't like to say too much. So anyway, we'll go ahead and get started with the leaps. If I can just get this to, there we go. Again, legally here, we're Discover Options is an option education provider, and myself, Papale Capital, is a registered rep. We're here. This is purely for informational purposes only, and does not intend to make an offer or any kind of solicitation. Okay, investments involve risk, and these are all purely for illustrative and educational purposes. All right, why does that look? Oh, this has got the new little thing. Okay, here's what we're going to go over today. We're going to talk about what is a leap. Okay, why do we deal with leaps? What's the big deal? Why would we want to use leaps? Why do we care about leaps? Some of the characteristics and risks of trading in leaps or investing with leaps. Okay, and then we're going to go over a couple of strategies. Okay, we're going to cover just a couple of strategies, and I'll model out a couple of these strategies with leaps. There is going to be a recording. There's been a question about a recording available. There will be a recording, and in fact, this entire presentation is going to be is being recorded right now. And the company, Discover Options, will have this posted online. Either Jeremy or Jim or whoever's back in there will usually get these real quick, usually by the end of the day or if not sooner. So this will be available for viewing, I think. All right, what is a LEAP? What is a LEAP? A LEAP it's technically defined as a long-term equity anticipation security. A long-term equity anticipation security. That stands for a LEAP. Okay? These things started in 1990. And just as a side note, one of the first products that they started using LEAPs, or they tested these out in, was the SPX. And I happened to be a market maker in 1990 in the SPX. So you get an idea how old I am. But these came in our crowd, and they started trading these at that time. And really, they're very strange product, because it was obviously options, but long-dated options, you know, stuff that goes out 3 years or 2 years or whatever. And I just remember the first several months trading these things, how wide these markets are, or were at the time. It was incredible. We were making markets like $5 wide. And so anyway, it was fun. I mean, I remember, I barely traded them at the beginning. It was very weird. Everybody was a little nervous. Now, if you look at some of these LEAP markets, it's incredible how tight they are. So anyway, the LEAP is technically defined as an option that expired, that's between 9 months and 3 years out, or 9 months and further out is technically a LEAP. Anything that expires within 9 months is not considered a LEAP. Okay, it's just a standard option, standard listed option. Okay, when you get into the LEAPs, you only can get January expirations. Okay, so if you're going to go out and do some LEAPs, you're not going to be able to trade, you know, all kinds of different months. Okay, they only trade in the Januaries. Okay, as the options get closer and closer to the present day, once they go from that more than 9 months into less than 9 months and become a normal option, then you're going to start to fill in. Then the listing, the exchanges fill in the months, and so you're going to start getting all that stuff filled in. But you just, when they're LEAPs, you can only trade January. The SPX has a 5-year LEAP, and apparently that, you know, obviously I'm guessing that's for institutions, you know, guys, money managers, people that are hedging stuff that's, you know, 5 years out. So, and LEAPs, you can trade calls or puts, so they have both calls and puts. Why LEAPs? Why do we care about LEAPs? You know, typically the same reasons we would use standard options. Okay, typically, not always. But they happen to include, they allow investors to participate in the underlying at a lower cost. Okay, in the case of a call, you have a leverage effect if you're using the LEAP. You can certainly hedge long term. Okay, so they're effective for risk management tool, and that's what these institutions are using LEAPs for generally as a hedge. They're not typically or generally used for sort of the income enhancement trading type strategies. You don't see too many butterflies in the LEAPs. You don't see people selling calls, you know, 3 years out against a stock to try to collect time decay. That's generally not what the uses of LEAPs are. They're really more designed as a portfolio management product. Now, there's some certain characteristics and risks involving LEAPs. So let's take a look at that. And that has pretty much everything to do with a longer time involved in these options, okay? As we start to add time, okay, into options, as we add more and more time, that affects all the Greeks, all the characteristics and all the risks of options. So if we take these one by one, okay, we take a look at the delta. Well, the delta of these things tends to be what I would call smoother. Okay, if you look across different strikes, and again, with the LEAPs, it's a little difficult because you don't get as many strikes either with LEAPs. Okay, not only are you stuck with 1 month, but you don't have as many strikes. You can request sometimes a specific strike, but they usually go in like 25 points or 20 or depending on the stock really, in the price of the stock. But the deltas tend to move less between strikes. The delta tends to move less across strikes, okay? As we add more time to, in general, all the option deltas, as a rule, tend to push themselves closer to 50 delta. Okay, so that means all the out-of-the-money options, okay, those deltas, as we add more and more time, tend to get elevated, and all the options that are in the money tend to get pushed down. And the reason for that is if we add more time, there's obviously much more possibility of options either finishing in and out of the money. So there's much more of a wide target, if you will, of where that stock might end up at expiration. So with that bigger target, that less certainty, that's going to generally cause most of those deltas to kind of push themselves a little closer to 50, okay, than they would if they were, say, a month out. The gamma is really the reason why these deltas tend to, or part of the reason why, at least for the velocity of the delta change, why they move less. Okay, it's smaller as you get a, think of an apple. Okay, we're going to use apple as an example. You got a 10-point move today, or a little while ago, an apple, or maybe around 10 points. If you got a month ago, that's going to push an at-the-money option a lot. It's going to move that delta, from 50 to whatever. Okay? But if you got a 2-year option, that's barely going to move, because with 2 years to go, a 10-point move in a stock doesn't really necessarily mean all that much as far as where that option is going to finish in or out of the money. So longer time, smaller gamma. Okay? Longer time, smaller gamma. The far out, what I call the tails, though, okay, the way out of the money options and the way in the money options, their gammas can sort of move up a little bit, okay, the way far out stuff. And the reason for that is if you only have a limited time, say we're looking at an option that's got 20 days to expiration, and you got an option that's way out of the money. It might have a 2 delta or a 5 delta. The gamma on that's going to be small, if not 0, okay? Because really, you need a monumental move in the underlying to cause those deltas to really move. So the gamma is very small. But if you have that same strike and you've got 3 years to go, okay, that delta might be, might not be 5, it might be 15 or something. But the gamma is generally going to be a little bit bigger because any given move is going to move that delta just a little bit. Basically, the front month option delta is treating that delta like it's almost 0. Okay, until the stock gets real close to that or moves to a point where those options are going to be kind of alive, it's going to really barely move that delta. When you get farther out, it can be a little bit bigger gamma, but it's, again, we're talking technical, not huge difference, but from a technically, it could be bigger as you go way out in the tails further out. Okay. Vega, higher across all strikes. More time, okay, means more time premium, bigger extrinsic value, more risk to changes in implied volatility, more Vega. Pretty straightforward. Theta, the rate of decay is lower as we add time. Okay. It typically follows the path of the extrinsic value over time. Okay, so as we add more extrinsic values, we add more time, the theta kind of tracks that path along. Obviously, any given additional month of time, theoretically, as we lose a month, that time is going to be eroded away, theoretically. This is a graph from the OIC, and this just represents sort of the theoretical call. This is the option premium, okay, the rate of the time decay. And you can see that the calls are going to be worth you know, 14 or 13 bucks with 31 months to go. And obviously the extrinsic value ends up at 0 at expiration day. But you can see that the rate of decay there really goes quickly as we move towards closer to expiration. Okay, and that's just like that curve that we have in the, for those of you who've taken the program, we have a curve, and as you get closer and closer to expiration, you know, 30 days out or whatever, the rate of time decay tends to accelerate a little bit. So the time decay is not linear, it's log normal. Okay, there's one other Greek that we don't really deal with too much in the program, but does come into play a little bit more when you're dealing with leaps because of the additional time, and that is rho. That's rho. And rho measures the sensitivity of options to interest rate risk. Okay. Options are a levering instrument. Okay. When we buy calls instead of stock, that gives us leverage. Okay. That tends to, as interest rates rise, calls tend to get appreciated in price and puts tend to go down in price. Okay. So there's certain interest rate effect on the price of options. Rho measures that risk. So clearly, with only 30 days to go, interest long-term rates or rates won't change that much. But if we got 3 years to deal with and we have options, there's a lot of risk and a lot of interest rate risk there. As interest rates rise, leverage becomes more valuable. You can see that if we don't have to spend $1,500 for a call versus $60,000 to buy the stock outright, the calls become more valuable in a higher rate environment. Rates go up. We said calls increase, puts decrease. Again, I talked pretty much about all these points. Not a big deal with short-term options, but obviously with long-term stuff, that can be big. When we used to trade leaps, we used to use $0 options, the ED. Not the currency, but the interest rate product that trades at the CME. That was what we used to use. You can hedge with that. So, all right. Some of the risks. Liquidity can be a challenge sometimes in some of these leaps. There's oftentimes not a whole bunch of open interest in these leaps, so you can have a liquidity issue. You can have some low volume, low open interest. Obviously, when we don't have a whole lot of open interest or volume, that could increase slippage. So that could, our transaction cost could be higher. Lower gamma means lower response to underlying movement. Okay, lower gamma, lower response to underlying movement, less hedging or participation. And we'll illustrate that a little bit when we model out. What I mean by that, especially for people that want to use collars, and we got a lot of, there's programs out there and groups out there that use leap puts as the put portion of their collar. And then what they'll do is they'll show short-term calls against it, and they'll manage their calls every month. If we get a big sell-off today and you got a 3-year option out there in the put, because the delta, remember the delta and the delta is going to gravitate towards 50 maybe, and the gamma is going to be smaller, you're not going to get the response or the protective effect from those puts on a big sell-off, you know, all else being equal, than you would if you have sort of an at-the-money put with only 30 days to go. Okay, so the gamma tends to be less, so the protective portion of that will be a little bit less too. Okay, so if you're looking to hedge a stock that you want to protect over the next 30 days, you know, obviously a leap put probably isn't the right put. And then again, the fewer strikes, we talked about that. Strategies, you know, there's nothing inherently special about leaps strategies. They're just simply longer dated. I mean, I've done some webinars about weeklies, and there's, you know, a lot of guys out there that are putting out these webinars and this information about, like, you know, I've got all the weekly strategies down. Well, like I tell my students and others, you know, we all been trading weeklies forever. It's called expiration week. There's no special weekly strategy out there. It's the same stuff we've been trading during expiration week. You know, we deal with expiration week specifically. We encourage people to, you know, deal with expiration week in a specific manner. It leads to the same thing. I mean, you have strategies, you've got risk and characteristics when you're dealing with options that have 2 or 3 years to go. Recognize them, make sure that what you're doing is what is appropriate for your goal and your risk tolerance, but, you know, that's it. There's no like, wow, this is a special LEAP strategy box that we're going to go into, and we're only going to, you know, it's nobody knows about it but us. And that's not how it is. All the strategies are you know, they're all out there pretty much. You know, LEAPs, you just have to watch the time issue. Again, the LEAP's more geared for the investor. Okay, these are options that are typically, you know, you're not going to be, you know, trying to scalp, you know, quarters out of LEAPs or something like that, or half bucks out of LEAPs. These are more of an investment type or portfolio management strategy. And again, and we'll see this with the collar, you can offset some of the cost of the LEAP by selling some of the short-term options. Okay, all right, we're going to do here, we're going to model out a trade here, and this is what I originally did. I'll walk through this, but then these prices might all be different because I haven't looked at the market here in like 30 minutes. So, but we'll use Apple as an example. One of a very common LEAP strategy that I've used and I know it's out there is sort of the diagonal, the calendar, the diagonal. Okay. So we'll kind of look at Apple, and as of a little while, a couple hours ago, Apple was trading about 410 bucks. You can imagine that if you needed to buy 100 shares of Apple, okay, without margin, you're looking at about 41 grand. Okay. If you look at the January, this is right today. There's 565 days to go, and this is the January 15th. I should have wrote that right. I got January 1. I forgot the 5. You could pick up that one for about $57. Okay, $57 was about where that 405 call was trading. So that's 5,700 bucks. You could offset some of that with the diagonal. You know, we're doing a diagonal now, so you sell the call, the front month call, and that front month call. This actually looked like kind of an interesting trade. That front month call was trading at 12 bucks, the 420 call. So that's 1,200 bucks. So you can see where your net cost there is going to be around 4,500. Obviously, long-term calendar. We would, in this strategy, we would typically roll the front month. Okay, August has got the 47 days, so you got to watch it. You got to watch for assignment. Okay, like all calendars, like all diagonals, like any strategy where you have a short option, a short call, you got to watch for your assignments. Okay, especially around for stocks that pay dividends. Now, I don't trade much Apple, and I know they're paying a dividend, or I think they're paying a dividend. You know, you want to make sure before this thing goes ex-dividend that your calls aren't in the money, because there's a high likelihood, there's a possibility, depending on how much extrinsic value is in the stock or in the call, you could get assigned. Okay, so you got to watch that. And then there's Greek risk. The way we talk about options trading in our program, and I talk to with everybody I talk to, you sell an option. That's where the money is a lot of times. In our program, we do a lot of time decay. We make money on a lot of it on theta, on time erosion. That's the income part of the option. There's the risk, though. The protection is in the long, okay? So they work against they kind of complement each other. The long tends to be the protection. The short tends to be the income part. Without the protection, you can make more income, but there's a lot of risk there. And if something crazy happens, you can get your head handed to you real quick. The further away these are from each other, the less they sort of complement each other and work off each other. So the less protection you're going to have from an option that's 3 years away in terms of time than you would from one that's a month out. So you got some risks here in the Greeks here that's a little different than when we use our do our typical calendar, which is generally is just a month, maybe two months apart. All right, what I'm going to do here now, folks, is I'm going to just share my desktop. So I won't be able to see any of the comments or anything, but I'm going to go ahead and we'll just do this trade or one like it, and I'll just show you what it looks like, and you can look. We'll just kind of look at the curve. It's a very typical diagonal. It's just bigger. It's the curve. Everything's bigger. It's like it's like Midwest skiing, little hills, versus Colorado skiing, big mountains. I remember when I lived in Colorado, everything was bigger in Colorado. When you're dealing with leaps, everything seems to be bigger. So anyway, let me share my desktop. We're looking at the 405, 420. Let me just try to remember that. All right. Now let's see if I can get my, no, that's not what I want. The wrong. Okay. All right, here's the matrix. And wow, we're getting a little sell-off here. Let's go down to Apple. It's up 13 bucks now. I think I might have this modeled out. All right. Here's Apple. For those of you that are may not have recognized this, I'll give you a very quick 15-second overview. This is Apple. This is what we call our matrix. These are the months. You can see that we got some weeklies here. Then you go out to July expiration at the top. I should get rid of these weeklies. I got too much stuff here. But this is the August expiration, September. This is the number of days. So we've got 47 days in August. This upper area right here with the C's, these are calls. Down here is puts. This little arrow represents the at the money, the closest strike to the at the money. Okay. Market price represents the market price. MIV is the midpoint of the implied volatility. Okay, the bid the ask. So we do a midpoint. And we got gamma. We got theta. So what we'll do here is, if you were to go, generally when I trade these things, with the leap, usually there's no right or wrong strategy on any of this. It's all about risk versus return, sort of. But I kind of pick something that's maybe a tiny bit in the money. Now I don't go too far in the money. These things kind of go up a little bit in price, but you can see they're not cranking out too much. You can see the gammas. See how flat the gammas are out here? They're all 28. I mean, we're looking between the 400 and the 435s. We got a 28 gamma. See these deltas? They're barely moving. I mean, you really, you don't have a whole lot there in terms of that. That's sort of what I was saying about that. As you go closer in, you'll see that different. But let's go ahead and buy one of these 405s. We're paying about 58 or whatever, 57, 58 bucks. So that would be our long-term, a call there. And again, there's nothing necessarily magic here. There's a lot of extrinsic value in these options, so you're going to have not a bunch of time decay anyway, because there's 565 days. So you pick a strike. I'll pick the one that's a little bit in the money, one strike in the money. You could certainly go more in the money. You could certainly go at the money. You could even go out of the money if that's what you're looking for. But we'll go with this 405. There's our cost. Here we are. So now what we're doing is we're going to say, okay, I'm going to go at the money, or the August, okay? And now what I typically do is look for something that's pretty far out of the money. And we're dealing with Apple, so I'm only going to go 10 bucks out of the money. It's up 13 bucks today. The one I modeled or one I illustrated was this, so I'll stick with this. I don't know if I'd pick this, honestly. I might pick something up here. But we could sell that for 11 or 12 bucks. Okay, so we've got the long 405, the 565-day out 405 call against these 420s that expired in 47 days. Okay, let me do something here. And let me just point this out. See the gammas here, how they change? Okay, the highest gamma is always at the money. Okay, and you can see as we move here, they're moving. I mean, not massively, but they're certainly moving. Okay, and same with the deltas. The deltas are moving too. In contrast to those leaps that we saw that looked like they were never moving. Okay, that's the characteristic. So, and let me punch in theta here, and here's our theta. So we're going to collect, or this thing's going to decay theoretically about 18 bucks a day. 18 bucks a day. Okay. As far as the Greek of the Greeks of the entire trade here, we're long a little delta. Okay, because remember we had the 405, so they were in the money. We're short a little gamma. Okay, because these are driving the gamma with only 47 days. Remember, with gamma, the closer to the at the money and the closer time-wise to today, the more impact on gamma, especially at the money. Theta, we're collecting theta again. The majority, we're collecting 18 bucks a day because we're short that. We're paying $5, $5.71. So we're net collecting 12 bucks. And then the Vega, we're long quite a bit of Vega here. Okay, because this thing has got a lot of Vega. We got 192 Vega here. Okay, lots of time. Okay, almost entirely extrinsic value. This thing is $4 in the money, $5 in the money, these 405s. The remaining $52 of this is all time premium, all Vega. All that time premium, all that extrinsic value is what changes if implied volatility changes. So 52 out of $57 of that trade has exposure to implied volatility. The part in the money doesn't change. That has no impact on changes in implied volatility. And you can see the Vega here with much less time to go, 56 bucks. Okay, so there's our trade. There's the structure of our trade. And what we'll do is we'll just pick a picture. Now you can see this looks like a typical sort of calendar diagonal. If we've modeled it out, you've probably done it, or I've done it a bunch of different times. It's just a little wider, okay, than what I normally see. Again, for those of you that aren't very familiar with our software, this right here is our P&L, okay, on the trade. This right here is our the underlying price, the stock. Okay, and this is just a snapshot of today, of right now. And this is how the thing, this dotted line represents how the model foresees this trade behaving on a P&L basis right now, today. Okay, so you can see if the market goes up a little bit, 422, we're going to make a little bit of money. Why are we going to make money? Well, we're long delta. We're long delta. This assumes no changes in implied volatility. Okay, and I can add some days, and you can see that we, in 24 days, if we don't do anything, the market doesn't move, this is going to actually be up some money. Why is it going to be up money? Because it's collecting theta. We're making money on our theta. But you can see we've got, at expiration, we've got quite a bit there in terms of where our break-even points are going to be. Okay, if we wait until expiration, we're way out here at like 460. What is that? 465, I guess, on the break-even there, and then down here about 390 on the break-even there. Okay, so this is a wide range. Now, the idea here is to kind of collect. Ideally, what you do with what's nice about these, and when they work out well, just like any calendar, the market's not going to go, screaming way up above the 420 strike. You want to try to collect as much of this $12 here as you can to help offset that 57 that we paid for. Okay? And then the idea here is when this thing starts to get close to expiration, either these are going to be in the money if it rallies, or out of the money and close to zero if we get down below 420, is to buy these back and then resell them. Try to collect more premium, and you'd go out, depending, you might go September, maybe you go out in October, but we've got a year and a half here to try to make that money back. Now, the risk in this is if the market really moves high or low, that's when we can get burned. Up here, we can get burned, and if it really, really rallies hard, we can eventually get hurt too. Okay. Remember, you're not getting a bunch of protection from these 405 calls on a gamma basis. Okay, they're a little bit in the money, and there's a bigger delta on those right now. This is a 40 delta. I think those were about 50-something delta, 52 or 56 delta. So, but you can see as we rally, they're not going to, the gamma isn't huge. I took the gamma down. It's not huge. You're not going to move a ton. Not going to move a ton. Okay. This isn't that much different than any diagonal or calendar that we do. Okay, it's just using leaps. The idea again is to try to keep rolling these calls, these front month calls over and over again. And if we can collect $5 to $10 every couple of months, you could see eventually we're going to be in this trade for, if it works out okay, we could be in this trade for nothing or even a credit. Okay. All right, I think that's the diagonal. Let me go back to the, let me go back here and, whoops, that's not what I want. Let me go, whoops, that's not what I want either. Where am I here? Let me go back. There we go. Okay. So that kind of illustrated the leap against the diagonal, the leap diagonal. Again, it's just kind of an exaggerated picture of the regular diagonal, the regular calendar. All right. Now, the other thing that you get a lot of, there's a lot of people you do is collars. Okay, especially now with the market's getting a little nervous. Potentially, at least a couple of weeks ago, they were getting very nervous, and people were talking about big sell-off and all the rest. Collar is a very popular strategy if you're nervous about downside risk. Okay, all the collar is being long a put and short a call. Okay, against it. And then you would typically do the same process with the call. The call is the front month call. Okay, the front month call. So it's the same kind of deal. Difference is instead of being long that leap call, you're long a leap put. I wrote in here the put can be left alone if desired. What I mean by that is you generally like the call in the diagonal. You don't really mess with it very much. You've got 560 days to go. You pick that call strike based on your ultimate downside risk that you want in a stock. Okay, it's not like the market's going to be going all over the place. You're going to be buying and selling that put necessarily. Now, if the market rallies a lot, you may want to potentially look at me buying that put back and rolling it up if you want to lock in a little more downside profits. But generally that put you don't mess too much with. Since put is far away, watch the protection in the shorts, that should say short call. Okay, that's again, the short option is the one you want to watch. And again, this one has the risk too. Just like the calendar or the diagonal, this has very similar kind of risk profile. The only difference is we're going to be doing we're looking at collar. So what I'll do is I'll go in here and I will again share my desktop. I think I got the wrong thing in there. There we go. All right, we're back to Apple. Let me get rid of this thing. Let's pretend we're long 100 shares of Apple. Okay, and we're nervous, but we don't want to sell it. We want to buy. We want to do a collar. Okay, and say that we're looking at, you know, we can do these 390s out here in January for 57 bucks, you know, God, 390. Stock could be there to, you know, by the end of the day. But say we want the 380 put. Say that we don't want to lose anything below 380. So we got $51, $52 is put's going to cost us. Okay. Now, the collar is a method. I mean, we could leave this like this, okay, and with the advantage of just buying the put without selling the call is we've got unlimited upside protection in the stock. So clearly, if the stock goes to 700, it goes back to where it was, whatever, 6 months ago or whatever that was, we're going to be able to participate in all that. Obviously, this put's going to go down, but the put can only go to 0. Okay, so our losses on the put are limited. The appreciation on the stock is potentially unlimited. So, you know, that's one, you know, and then you have this. Essentially, this is a call. Okay, if you model out the call on the same strike, the 380 call, this is what you're going to see. Okay, but we're collar traders, so we're going to go ahead and look for a call to sell against it. So the question now, when you're dealing with calls, there's two things, or collars, there's two things to consider. One is how much am I willing to, or how much do I want to offset the cost of my put? Okay, I forgot already what I paid for that put. I paid let's say 52 bucks. So we paid 52 bucks for the put. I'd like to offset, you know, yeah, I don't know, 8 bucks. I mean, we've got a long time to go. To me, I would be willing to, God, these seem like high premiums with only 47 days. You know, I'd be looking to sell something maybe like this probably. I get a lot of upside protection. I get a lot of participation. I mean, a lot. It's Apple, but I've got 25 bucks on the upside before this call gets, you know, before I get capped out in my upside. And I collect $7 bucks. So I've got $7 to offset that $52 put. So now I'm down to $45 net cost right here. This cash flow, 45 bucks or 45,000. This takes into account the stock cost and all that, but you're looking at the deltas and all that. You can see we're long a little bit of delta. Remember, we're long these shares. This is the actual collar here. We're short some gamma, long some, collecting a little bit of theta, again, from these calls. And again, just like the collar or the diagonal, long a lot of vega. Okay. This looks weird. Oh, I know why. Yeah, you got, here's the thing. For those of you that are let me just make sure I got this in right. Short 135 call, long, yeah. For those of you that are expecting to see a picture that looks just like a call spread, a bull call spread, for those of you that have been on my webinar that compares collars to bull call spreads and they look exactly the same, this, you're going to be like, what the heck is this? This doesn't look at all like a call spread. Well, the reason is because the distance between the leap and the call, the short call. When you start to get that, the offsetting effect between the long and the short starts to kind of go away from each other, and you end up with a picture here that looks like this. Okay. Here's our loss. If we you could see that we kind of, well, this is just bent down like this on the rally, because the problem is that the put doesn't go to 0 very quickly. Okay, we get capped out here at the 435 point, and then we start to come down, and we come down. The other issue is that we pay so much more for these puts than what we sold the calls for. So if they both go to 0, you can see we're going to have a problem here. Anyway, you have if we go down, you could see that our loss is going to be limited. Okay, at some point, again, it's just what we, you know, the strike price of the 380 is where we're going to end up getting stopped out. but you've got kind of a funky collar. The idea with the put here is that you're planning on keeping that put for 3 years, and your ultimate downside risk or your target for downside is 380, okay, in 3 years. No matter what the stock's going to do, whether it goes up or whether it keeps going down, those puts are going to stop you out at 380 on the downside. The management of the call is what's going to really drive your ultimate profitability or loss, okay? And that's really what's going to move that thing around. But you can see right here that on the upside, we're going to end up taking a loss because those calls are really going to get in trouble. They're going to go against us a lot more than those puts are going to than the stop out on the stock. And those are going to kind of go offset 1-to-1. For what we make on the stock, we're going to lose in the call, and then we're going to be losing on the put. Okay. So that's what the graph looks like on that. Again, it's a very popular strategy for funds to do. Funds do this quite often. They buy a leap put, and they'll just roll the calls. And eventually, if the market doesn't move monstrously up, it can work out okay. The risk in these kind of trades is if we get a huge rally in the market, it can underperform pretty dramatically the market. So last year, for example, if you had a strategy like this on, you probably would have underperformed fairly significantly. But that's the collar. Let me go back here and hit the PowerPoint. All right, that is the, again, let me see, I think that's all I have there. Yeah. Okay, in summary, you think of the leaps are sort of the calm, mature, older sibling to the weeklies. Okay, you know, the weeklies are much bigger gamma. And when I speak about the Greeks, I'm going to talk about the at the money. The weeklies have a tremendous amount of gamma, obviously, tremendous amount of time decay, less vega. Leaps, much lower gamma, much flatter deltas. So you can think of them as the mature, and the weeklies are the, think of that cheese commercial with the Kraft cheese, you know, the immature cheese versus the, trying to think of mature cheese, you know. Frank knows his cheeses. He'd probably help us out. Anyway, longer time to expiration has an effect on Greeks. And we see that. We see that in the actual matrix when we looked at the Greek, the actual Greeks. And we also saw that effect in the illustrations, the way the model portrayed the performance on these trades, okay, the unadjusted performance on these trades. Remember, not all strikes may be available, so keep that in mind, as we mentioned. And again, these aren't really what I would consider options that you're, you know, what I would call trading. Okay, you know, you're not going to be scalping, scalping options and stuff like that on the moves. Okay, these are portfolio. I would consider these as more portfolio management or portfolio type strategies. But again, I mean, I've traded this calendar. I did these for a while in Walmart. I remember Walmart. I was doing a lot of leaps against calls. I would write front month calls and buy. I didn't buy this. It was like a 2-year leap, maybe. Maybe it was a little bit under 2 years. And then I would just try to roll the calls. I mean, Walmart was a fairly stable stock. Didn't get creamed. It was, you know, it's a solid, you know, dividend-paying stock. So I would just try to roll, you know, the out-of-the-money calls, roll the out-of-the-money calls, and it did okay. But that's, you know, that's sort of the idea. All right, folks, that's all I got on the leaps. I don't know if there's any other questions, but again, if anybody has any questions about this in the future, or you come up with something, there's my contact information. You can reach me at the Discover Options email with any option stuff. Is it vega a key variable for leap calendars? Yes. Vega's key. Like we showed in the matrix there. Vega is much bigger with the leap. Now here's kind of the interesting thing, Paul, when you're talking about the Vega, and you probably know this, but for the rest of the folks, even though the Vega on an absolute value, you know, Vega measures that for every 1% increase in implied volatility, our P&L would go up by the amount of Vega for long Vega, for example. Okay. Well, when you go out 3 years, you have a much bigger Vega number. So for that 1% increase, you're going to have a much bigger effect on the position. The trade-off, though, is these leaps, the implied volatilities, we go out further in time, generally, folks, the changes in implied volatility is less. So, for example, if we get a sell-off like what we saw a couple weeks back, the change in implied volatility, that increase in implied volatility in the front month was like, I don't know, 2%, say, for one day when we had the day we had a couple big sell-off days. So we might get 2% increase in implied volatility in those front month options. But if you go out, you know, 3 or 4 months out, the increase in implied volatility might only be 0.75% or maybe 1%. And if you go out into the leaps, it could be less than that, maybe 0.5%, maybe not even anything. So though your exposure to any given change is greater, the actual change itself is less. So, you know, that's kind of the rub on that one. When IV is too high, it's obviously not good to buy straddles or leaps. Any guidelines? You know what, Paul? Paul, number 2 there. I get folks asking me a lot about, you know, IV's high, I don't want to buy Vega, or low, I don't want to sell Vega. It's difficult to predict volatility and where it's going to go, at least in the short run. You know, if you have a high, generally the IVs and the leaps aren't going to get to a level, I don't think, where you would necessarily get nervous about buying, you know, implied volatility, buying the Vega out that far. As far as the short run is concerned, you know, vols can stay at levels either high or low for a while, and it sort of depends on your time frame in terms of how long you're going to do a trade or be in a trade. I mean, we've done just fine selling Vega at, you know, with the VIX trading below 20 for a long time, and which historically, when I mean historically, with looking at the VIX, I'm looking at that, you know, looking back 9 months to a year, is fairly low, you know. So I think now 15 is about as low. I mean, maybe the VIX got, well, I think it got down to 12, but so I don't know. I don't worry too much about that. I think you got to just, you know, if the VIX extremes like we saw back in 2008 or whatever, you know, I think maybe, yeah, but you got to look at the time frame, I guess, is what, you know, you could scalp a lot of gamma with a straddle and make a lot of money in a high volatility environment, just fine. You know, if you get out of that, I wouldn't want to necessarily stay with it for a real long time. Mostly hedge use only. Mostly, Salim, I'm not sure I understand your question. Mostly hedge use only. Are you asking if the leaps are used for mostly as a hedge? Okay. I think it depends on what you're trying to hedge here. I think if you're you know, most portfolio managers, I don't know that they're using a lot of leaps to hedge portfolios of stocks unless you're collaring it off. I think, and the only reason I say that is because of what volatility does during market sell-offs. Generally, I think there's an increased demand for the short month stuff for 2 reasons. One, if you're a portfolio manager, I know we got at least one former portfolio guy here. you could probably, anyway, comment on it. But you know, some guys that I know have a certain amount of money, and they, in a panic, they're in there trying to buy protection, and the best bang for their buck is those front month options. They get more cheaper options with greater gamma. But if you have a strategic plan in place and you're out there using leaps to protect a basket of stock, you know, I guess that's something too. So, is a leap? Oh, let me see. Just went blank on my screen. Is leap put price a measure of cost of liquidity for the underlying? Is a leap put price a measure of cost of liquidity for the underlying? I mean, the price of the put is a function of the extrinsic value and the intrinsic value, and then, you know, a function of the model, the implied volatility and interest rates. It all comes up with the price. The liquidity factor, the fact that there's less liquidity in the leap, is certainly going to cause the bid-ask spread to be wider, which is sort of an increase in transaction costs for us as buyers or sellers of the leap. So yeah, I mean, that certainly is going to play into it. All right. Thoughts for that? Okay, Salim, I think okay, I got you. Okay, good. Good questions. Yeah, there's the Vega is the biggie. The Vega is the biggie with these leaps. So kind of watch that Vega, but that's what I got. So you know, if you got any other questions, folks, there's all my contact. I'm always happy to answer. And if you have any other suggestions for topics, I put this out every week, and maybe once in a while somebody will send me an idea, and I'll always use it. But anyway, if you have any ideas, please let me know, because I'm happy to incorporate it to one of the next, you know, the next one I have. So, all right, well, it's 2 o'clock here, and I guess I will sign off. It's been a pleasure. I've enjoyed this. Thank you all for being here. Enjoy the rest of the day, and enjoy for those of you in the United States, have a great holiday week. Take care.